So, in this video, we're going to talk about retail capitulation. We'll have a note about Bentley and what it says about Tesla. We'll also talk about what retail buyers are thinking about Tesla, talk a little bit about inflation protection, and, of course, what Barron's just told me about one of my favorite stock sectors. But first, I have to address this random comment I got yesterday. Somebody's like, Kevin, do you have an obsession with always showing us that you're holding coffee? Do you have a problem? And I'm like, yes. I don't understand comments sometimes, but honestly, I love the collection of coffee mugs that I have. This is a super restore potion, and I only have like 7 cups of coffee a day, so it's totally normal and not a problem. Anyway, so Bentley just reported massively weak demand coming from China. Remember that the Chinese consumers, the higher end consumers, I should say, really like nice cars. And there's a potential that if we're starting to see a drop-off in luxury cars over at Bentley, which is historically something unique, then that could potentially also explain the drop-off in demand that we're seeing in China for Tesla, which would isolate the demand drop-off for Tesla to China rather than to the rest of the world. Now, I did a pretty deep analysis on, well, on my thoughts, okay? I don't want to make it seem like I went ridiculously deep here, but I went pretty deep on some of my thoughts on both Trade Desk and Tesla in a course member live stream 2 days ago. And I want to know from you, I was thinking about, as just sort of a free sample, posting that entire analysis. It comes with my price targets for Tesla as well. If you want to see that, just leave a comment down below and go, post the PP live stream in honor of the coupon code expiring Friday, which gets you lifetime access to any time I go live in the course member live stream. Okay, so this is interesting to me because China's clearly having economic issues at the same time as now the Politburo and the government, the Chinese Communist Party, are essentially suggesting, hey, you know what, we're going to go ahead and pull back some more of the COVID curbs once again, now finally allowing individuals to quarantine at home rather than in quarantine hotels if they're otherwise safe and not a threat to other individuals. This is a big shift. We've always seen these COVID curbs kind of trend down where, okay, instead of spending 10 days in a COVID hotel, now it's 5 days. Now it's potentially 0. It's a pretty big shift, and it's a continuation of the likely gradual and rocky exit we're going to see China go through from COVID-0. Keep in mind, The Economist says there's really no win-win solution here because if they reopen too quickly, they have not actually prepared the Chinese people enough to be ready for a full-on COVID storm. That is, The Economist is projecting potentially as many as 800,000 people could die, and there could be 5 times the demand for ICU beds as ICU beds are actually available in China with a full COVID elimination or COVID restriction elimination, right? So in other words, all of COVID-0 just being turned on its head and just a full-on reopening could lead to a complete disaster. Now, on the other hand, as we talked about a couple days ago, the slower China escapes from sort of these COVID-0 restrictions, potentially the longer they will continue to be an anchor for global inflation, which is actually somewhat a good thing for the rest of the world, not just potentially for fewer deaths happening in China, but also potentially for helping inflation stay low. Because if China just goes right back to booming, it's going to help push up some more inflation. You know, one of the reasons oil, by the way, is falling right now, which is nice. I mean, we just went under $80 a barrel. And I mean, this stuff fluctuates on the daily basis, but Brent's right at 80 right now. The Western WTI is sitting at about 75 bucks. We're negative for the year on oil. It's actually pretty shocking. But we've got to talk about retail here right after I mentioned that yet another equity fund has limited withdrawals. Can you believe this? First, Blackstone's non-traded REIT limits withdrawals. Sorry, can't get your money out. Then Starwood's non-traded REIT limits withdrawals. Now Blackstone's private equity fund, the largest business development company in existence with over $22 billion in assets under management, has hit their cap of 5% withdrawals. In other words, everybody's trying to get their money out of everything to increase cash. Cashola. Cash is king in a recession. Of course, somebody that I'm going to bring up here, another YouTuber, apparently does not think so, but I am a little bit confused. by their tweet. We'll handle that in a moment. But first, we need to address some charts. Retail flows are starting to fall before data releases. Now, this could be normal. Personally, I actually think this is the smart thing for retail to do. I'm going to move myself here. I think that when you go into reports like a CPI report or FOMC report, generally you would expect to see the lowest inflows, because why would you buy right before reports, right? Now, you could potentially buy the dip right before reports, but anytime you have a critical report like the CPI inflation report coming out on Tuesday, which is in 6 days, why would you throw money into the market when if we get a bad CPI report, we could see all indices down 5% before you even have a chance to sell? And remember, the CPI report comes out before the market opens, so even if you're like, oh, I'll set stop losses, those probably won't trigger until the market opens. Okay, so it kind of makes sense. People are like, you know what? Let's just wait. Let's just wait and see. Anyway, this chart here, the purple line is what represents retail inflows according to VandaTrack, and it's plummeting. We are almost at the lowest levels that we've seen for retail inflows all year long right here, with only really after Jerome Powell's Jackson Hole us having a lower time, similar to what we briefly had there around the bottom of the market in July, although we did hit a further bottom after that, which you could actually see exemplified here and here. So I guess this was a little bit right after the bottom of the market, but anyway, you get the idea. Okay, so what else do we have? Well, look at this particular chart. This is retail purchases of individual stocks on a rolling 21-day basis. And what you could see is that AMD has been relatively stable. You could see that Amazon has kind of dropped off after a little bit of a rally over here. You've had Netflix drop off, Microsoft drop off, Facebook drop off, and Apple drop off. Pretty much every single stock, retail heavy, which these are really the large cap stocks, the ones that kind of everybody has in their portfolio. Almost all of these have fallen off in the last month-ish here for retail purchasing, with the exception of one, baby. And that one is the gift that keeps on giving, Tesla. And it's the gift that keeps on giving because, as you can see here, the more the black line goes down, which represents Tesla's price, the more retail does the apish thing and says, I'm buying this son of a gun. Give me some more Q. When the P goes down, I increase my Q. Look, that's me too, okay? Like this chart is me. I like it. I like it. I like price go down, I buy Tesla, okay? I like. But I also realize that even though we expect Tesla to go to the moon at some point in the next 5 years, if I had any need for my capital within at least the next 2 years, I probably would not be doing this. And I certainly wouldn't advocate this. Look, y'all know this. You know I'm a licensed financial advisor. You know I run an ETF. You know I'm a real estate broker. You know I've got educational courses, coupon code PP expiring Friday, okay? With new content coming out this month. This is not to give you personal financial advice, but I'd like to be very, very clear here. Buying the dip in a recession is a wonderful, wonderful strategy if you're not interested in trying to play the timing the market game and you have that long-term belief that what we are seeing is actually value. And in my opinion, I actually think we see value at Tesla. Now, if y'all want, you leave those comments, and I'll release my longer thesis on Tesla and my commentary on price targets. Just leave a comment down below. Maybe I'll do that later today. But you've got to think about it this way. If you actually think that Tesla's going to grow at least 45% in earnings per share, the recession protection story is actually still present. I know that sounds insane. I know some people are going to go, how? The thing's down 50% this year. I get it. A lot of things are down a lot, and this is no exception. But you've got Twitter overhang, you've got China overhang, right? You've got a lot of issues going on. You got Elon selling overhang. If Tesla grows at 45 at a 45% basis on its earnings per share during the 2023 recession, every quarter, just 45%, 45%, 45%, 45%, or more, right? It could be 50%, but I'm just going to go with 45%. And their forward PE ratio right now is sitting at somewhere around 40. That puts their PEG ratio at under 1. That is a really good deal for growth. And it's not just Tesla that's starting to look like a really good deal for growth. It's actually also companies like this right here. Barron's did a great piece on this, and I believe in this. AMD, Nvidia, some of the other chip manufacturers, these are high pricing power companies. These are high margin companies. And maybe, just maybe, most of the pain has already been priced in. No guarantees. No guarantees. Things can go absolutely crazy. But anyway, in addition to seeing individual stock purchases plummet, another thing that you're actually seeing is you're seeing investments into energy finally start to roll over with retail investors. Now, this is an interesting one because a lot of people were really following Wall Street into oil companies, but now that oil's gone negative for the year, which basically just means it's a lower price now than what it was at the beginning of the year. You're actually seeing retail purchases of oil stocks plummet. Look at that plummet. I mean, we're almost at some of the lows that we've seen this year, but we're definitely on that massive downward trajectory here. Another thing you see is that this right here is the S&P 500, this top dark blue line. This right here represents your call put premium, which is just basically a ratio of if you divide calls by puts, how expensive are calls. And you can see that calls right now are actually at probably the least expensive level that we've seen since before the pandemic. That's pretty remarkable. Pretty remarkable. In addition to that, we are seeing retail net purchases of individual stocks overall plummet at the same time as retail purchases of ETFs are declining. This actually implies that people aren't doing the typical seasonal tax loss harvesting. See, usually what we see is we see a plummet, like over here. You see a plummet in stock purchases, and you see an increase in ETF purchases. Plummet in stock purchases, increase in ETF purchases. The reason people do that is to tax loss harvest while still having exposure. So for example, you sell Tesla and then you buy a stock that has, I don't know, a 20% exposure to Tesla, or an ETF that has a 20% exposure to Tesla. At least you still have some upside while being able to avoid potentially the wash rules. Which, if you're not familiar with tax loss harvesting, talk to a CPA, do some Googling on tax loss harvesting. You sell, you have to wait at least 30 days. You can't buy a derivative, which is like an option. You can't buy something substantially similar, right? So usually people end up taking an ETF, but you're not actually seeing that right now, which is interesting. You're just seeing a decline in both. You're seeing outflows in both, which I personally think is a sign of people raising cash, which I think is a smart thing to do. I've been saying since January that the best asset class this year is likely to be cash. I wish I believed in myself more. Well, it wasn't that I didn't believe in myself more. I just saw really good deals in the stock market and I started spending my cash. But I wish I held more cash this year. It's the one thing I wish I did more of this year. And I talked about how cash was going to be the best hedge against inflation in 2022. And people got so mad at me. They're like, how stupid are you? How stupid are you to say that when inflation is 8%, your best hedge against inflation is cash? Like your cash is just losing 8% in value. Well, there are two ways you could look at this. One, you could say, yeah, maybe my cash lost 8% in value, but my stocks lost 50% in value or 20% in value, whatever you were investing in, right? That's one way people might look at that. So like cash is not as bad. But that's actually not the way I look at it, even though it's a pretty simplistic way to look at it. I think the way that takes a little bit more logic to think about is this way. If your cash is being used to buy food or gas or rent, then yes, your cash has lost money. But if your cash was actually being used and you waited patiently to buy stocks or bonds, basically assets that ended up declining in value, your cash PP, your cash purchasing power actually increased. It didn't go down. It increased. And this is what I said in January. I said, cash is not trash. When assets go down, your cash becomes more valuable if that's what you're buying. So you're actually having deflation, right? Assets are deflating, making your cash more valuable, not less. And this is where I'm like, dude, Graham frickin' Stephan, what are you doing? Somebody here, you know, this person goes, Graham goes, what's the best investment you have made this year? Somebody goes, not investing. I mean, they're actually not wrong. That's a very smart statement. Like, yeah, looking back, it's like, damn, the money I didn't invest was good. And then the reply here is, it's not like cash was a better option with high inflation. Like, what? Yes, it was. I want to just shake you. Like, yes, it was. Cash was the best trade in 2022. Any fund that had a large cash position killed it in 2022. What are you saying? Ah! Sorry, I had to get that out of my system. Anyway, 10-day net retail purchases with leverage and without have overall declined. Leveraged purchases and non-leveraged purchases. Well, I'm sorry. This is leveraged ETFs with leverage or without. This would be like a triple QQQ or a short QQQ, right? So, or like a 1.5x Tesla, whatever. Purchases of leveraged ETFs have just overall been declining, whether they've been with leverage or without, which basically means are using margin to buy a leveraged ETF. This chart is telling you risk off. Okay, retail shutting down. And I think that's really what's happening here, is you just have retail shutting down. It's kind of like, you know what? Mic drop. Peace. I'm going to take my time. I'll come back. I'll come back when things are different. I do think that a little bit of what's happening here. Short U.S. equity ETF purchases. I mean, here this shows you inverse ETFs, SQQ. You see a little bit of a rotation down here. So this is a pretty noisy chart. I do like this chart a lot because it just shows you where the retail purchases are really going in the last 5 days over here. It's mostly Tesla, followed by Apple, Amazon, Nvidia, that's a great one. AMD, great one. I think these guys are knocking on the door of bottom. I think Meta is a massive mistake. I personally would not bet on the Chinese consumer, although the stock has gotten pretty darn inexpensive. For me, I think Meta is a dumpster fire. I think Mark Zuckerberg's got to go with his metaverse idea. I think Facebook should get really good at ads and stop trying to play the 20-year bet. At least not with the amount of money that they're spending into it in a recession. I don't know. That's my take. Lucid, I think this is a bankruptcy risk right here. You look at my video. You just YouTube Lucid, Rivian, bankruptcy, meet Kevin. You'll see it. Taiwan, I like this. Apple's huge partnership coming up. Oxy, I think actually is a good market hedge. I'm not opposed to this. I do not like the valuation of Activision Blizzard. I think it's really been propped up on the idea of the merger with Microsoft. And yeah, I'm not going to go down the rest of this list here. You can kind of pause it and look. I've been, personally, I have to say I've been tempted by a firm, but boy, the risk is high. The risk is very high. I've been tempted by it, but I haven't been in a firm for a very, 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 very long time. I'm actually surprised I don't see, oh, there's Enphase. I was looking for it. It's way down over here by Delta. Anyway, so let me know, comment down below, PP course member live stream or something to that effect, and if we get enough likes and comments on that idea, I will reveal this like hour-long live stream sample on Trade Desk and Tesla. I actually think it's very informative. It's roughly what we try to do on a daily basis. It gives you a good sample, and it provides some more insight into Tesla, which I think a lot of people are asking for right now. Anyway, thank you so much for watching. Cheers, my friends. Good luck on your trading day. I am flying to New York, baby. Let's go.